Something happened in the silver market this past weekend that almost nobody is talking about. I looked at the COMEX order flow 3 separate times before I believed what I was seeing. You're probably thinking silver just dropped 7% this week, so why would anything about a quiet weekend matter? Stay with me, because that drop is exactly why this pattern is worth your next 10 minutes. I'm going to show you 3 things in this video. I'm going to show you what actually happens to silver volume in the hours between Friday's COMEX close and Sunday night's Globex reopen. I'm going to show you why that thin, overlooked window has quietly preceded some of the sharpest multi-day moves in silver over the last year. And I'm going to show you exactly where this leaves us right now, with silver sitting under $56 an ounce and gold holding near $4,000. Before any of that, one thing needs to be said clearly. Everything in this video comes from CME Group's own COMEX data, from Silver Institute supply and demand reporting, and from desk commentary out of Bank of America and Goldman Sachs. This is not a hot take. This is a walk through the numbers, and I want you watching with the data open in your own head, not just my opinion in your ear. Let's build this from the ground up. Silver hit an all-time high of $121.58 on January 29th of this year. Since then, it has round-tripped violently, and as of this week, it's trading in the mid-$50 range, down more than 19% over the trailing month alone. That kind of drawdown after a parabolic top is not unusual on its own. What is unusual is where the heaviest COMEX volume has been clustering. Normal market structure says Friday afternoon volume tapers off as desks square positions before the weekend, and Sunday evening's Globex open is thin because Asian and early European liquidity providers are just stepping back in. For most of silver's history, that has held true. But look at the last several Fridays into Sunday reopens, and you'll see open interest building into the close rather than unwinding, followed by outsized directional moves in the first 90 minutes of Sunday trading. That's the first open loop I want you holding on to, because I'll come back to exactly which contracts were carrying that weekend open interest. The second thing I want you holding on to is the gold-silver ratio, because it just told us something it rarely tells us this cleanly. And the third loop is this week itself, because silver's slide below $56 didn't happen in a vacuum. It happened alongside U.S. strikes on Iranian targets and a fresh wave of rate hike repricing. And those two forces are pulling the metal in opposite directions right now. Keep all 3 of those in mind, because before we get to where this goes next, you need to understand why weekend volume behaves the way it does at all. Here's the mechanism, step by step. COMEX silver futures trade under the ticker SI, 5,000 troy ounces per standard contract, with a micro contract called SIL for smaller size. Daily volume regularly clears 50,000 contracts, which is roughly 250 million ounces moving on paper in a single session. That is a market dominated by financial positioning, not physical delivery, which the Silver Institute's own supply data backs up when you compare COMEX turnover against actual annual mine production. When institutional desks want to build or unwind a large directional position without moving price against themselves during the liquid New York session, the low-volume hours are where that gets done quietly. Friday's closing hour and the first hour of Sunday's Globex session are exactly that kind of low-volume window. A large order that would move price 2 or 3% during Tuesday's peak liquidity can be absorbed more slowly across those thin hours, and the market doesn't fully register the shift until Monday's volume confirms it. That's the mechanism. Now, here's the second historical comparison, because this isn't just a theory I'm applying to one chart. Go back to the run-up before silver's January spike to 121.58, and you'll find the same footprint. Weekend open interest building quietly in the days before the breakout candle that everyone remembers. Go back further to gold's move through $4,000 earlier this year. And Bank of America's own commodities desk flagged unusually persistent weekend positioning in gold futures as a precursor signal, well before the retail narrative caught up. 2 separate metals, 2 separate moves, and the same structural fingerprint sitting underneath both of them. That's not coincidence, that's positioning happening where the fewest eyes are watching. Now let's talk about the gold-silver ratio, because that's loop number 2 and it's time to close it. When gold trades near 4,000 and silver trades near 56, the ratio sits in a zone that historically compresses hard once macro uncertainty peaks and then starts resolving. A compressing ratio after a spike like this usually means one of 2 things is coming, and I'll get to both of those paths in a moment. Before that, I need to ask you something, because this is the part of the video most people skip past. And skipping past it is exactly how people end up on the wrong side of moves like this one. Are you the kind of person who watches a setup like this build in the data and actually does something with it? Or are you the kind of person who waits until the breakout candle is already 3 days old and the headlines have already caught up? Because those are 2 completely different outcomes from the same information. The trader who reads weekend positioning before Monday's open is working from a different starting point than the one who reads about it on a finance app, push notification after the move already happened. I'm not telling you which one you are. I'm telling you that the data doesn't wait for either of you. It just keeps accumulating in the order book whether you're watching it or not. Strong hands in this market are the ones tracking open interest into thin liquidity windows week after week until the pattern either confirms or fails. Weak hands are the ones who only show up once the move is already loud. And by then the entry they're chasing is the same entry the strong hands already took days earlier. So which side of that line are you standing on right now, with silver sitting under $56 and a fresh Iran-related supply shock sitting on top of a rate decision that's still unresolved? Now let's close this out with where the two paths actually go, because I'm not going to pretend I know which one wins. In the bull path, weekend open interest continues building the way it has the last several cycles. The gold-silver ratio keeps compressing as safe haven flows rotate from gold into the cheaper metal, and Middle East supply concerns keep a bid under both metals into next month. If that plays out, a retest of the $60 level comes first, and a pushback toward the $70 zone that bar chart's trendline work has flagged for early spring becomes the next real test, likely inside a 6 to 10 week window. In the bear path, the current rate hike repricing holds, the dollar firms as Treasury yields climb further, and the same weekend positioning we've been tracking turns out to be short side hedging rather than accumulation. If that's what's happening, $50 becomes the next real support test, and a failure there opens the door back toward the mid-$40 range last seen before this year's parabolic run even started. Both paths start from the exact same weekend data. The only thing that separates them is which direction that quiet positioning was actually leaning, and that's something we won't have full confirmation on until we see how the next 2 or 3 weekend sessions behave. So here's where I'll leave you. Next Friday's COMEX close is coming, and behind it sits another one of those thin, overlooked Sunday reopens. If the same footprint shows up again, in the same contracts, at the same kind of volume, what does that tell you about which of these two paths the market has already started choosing?